You've got questions. We've got answers. We have the man to answer them. Jeffrey Levine from Buckingham Wealth Partners. Jeffrey, welcome back to another episode of Ask the Hammer.
It's good to be back with you, Bob.
Good to have you back. I've got an inbox full of questions, and one of which is a bit lengthy. Here goes. My income for 2021 will be approximately $227,000, of which $161,030 is my RMD. This income puts me in the middle of the 24% married joint federal tax bracket. My question, how much am I allowed to convert to a Roth IRA? And two, should I take out additional RMDs from my traditional IRA to get the highest level in the 24% bracket? If yes, how much would I be allowed to convert? Any additional information that you might need, I can provide.
All right. Well, let's unpack that in a few ways. First, let's talk about how much can I convert? And what we know here about this individual is they are old enough to be taking required minimum distributions, nice, healthy required minimum distribution at that. And with that said, you cannot convert your required minimum distribution. That is not allowed. However, once you've taken your required minimum distribution, you're free to convert whatever you want. So I don't know what your balance is. It's probably pretty significant based on that RMD, but that means you can convert any amount above and beyond that. So for argument's sake, let's say someone had a $100,000 required minimum distribution and a $2 million IRA. There's nothing to stop you from taking that $100,000 required minimum distribution, doing whatever you want with that, and then converting the balance. Can't convert the RMD itself, but any amount in excess of that is up for grabs. Now, in terms of should I take more, like a bigger RMD, there is no such thing. Let's start there. The required minimum distribution is just that. It's the required minimum distribution. So you can always take more. Now, if you don't need it and you're only taking it to, let's say, fill up your tax bracket, then generally you're going to want to convert that, because either way you're paying the same tax, right? Whether you take it and put it in a bank account or whether you take it and convert it, the tax rate is exactly the same. The difference is if you convert it, it's not just what you convert or what you take out that will be tax-free going forward, but also presumably, as long as you follow the rules, your future income, the future growth that is generated on it, all the interest and dividends and capital gains, that if you put the same dollars in a taxable account, paying the same initial tax bill, would all be taxable in the future. So I think at a high level, that sort of answers the question. Now, as to whether you should go to the top of the 24% bracket, it depends. For some people, that makes a lot of sense. For others, it should be higher. Maybe you should be going into the 30s if your future income will be that high, or if you fear future tax changes, tax rate changes, or if you're married now and in the future you might be single if either you or your spouse pass away and you're stuck using the single brackets in the future. In fact, this person must be married given the brackets we're talking about here. So all of these factor in, but let's not forget, income taxes are only part of the equation. What about Medicare premiums, right? Those are based on AGI, not taxable income. And taxable income is what we use for the tax brackets. AGI is what we use for Medicare premiums, or MAGI, technically modified adjusted gross income. So balancing all of these things can become relatively difficult. And candidly, this is where a good financial or tax planner can come in handy to say, here's what we project your future tax rate to be if you do nothing. Here's what we can do if you want to accelerate some of that. And look, at the end of the day, we have to pay tax on it. It's going to come out at some point. It's going to be taxable. The question is, when do we take it out at the lowest possible tax rate?
Right. So just a quick follow-up. A question about when to take it. You would have to take the RMD before you did the conversion, or does it matter?
Great question. And this is actually one where unfortunately I see a lot of mistakes, and it's really an esoteric rule, but it's a rule nonetheless. And it's that the RMD is considered to be the first dollars out of an account each year. So if you are planning to do a Roth conversion, you do first need to take any RMD from that account. Now, you may have multiple accounts, and if you want to do a Roth conversion from account B, you could take account B's RMD and then convert there before you take the RMD from account A. But you must take the RMD for that account from which you're converting prior to any sort of Roth conversion for the year.
All right. I think that deserves a hammer and then some.
Excellent. Well, it's a good question, and we love good questions, and we want as many of them as we can get. We'd like to help as many people as we can. So if you've got a question, please reach out to Bob and I. Drop us an email here at askthehammer@buckinghamgroup.com. Again, that's askthehammer@buckinghamgroup.com. And Bob and I look forward to answering your questions real soon.